So Jerry, I was watching the news and I see that federal rates are on the rise. Does that in fact affect the mortgage interest rates?
Well, it's funny. Last week, the Federal Reserve raised rates 1/4%, but after they made their announcement, mortgage rates actually came down. So what the Federal Reserve does is the Fed funds rate, which is what the Federal Reserve raises or lowers, affects when banks want to borrow money from the government.
Mm-hmm.
That's the rate that they pay, and so it affects things like car loans, it affects things like equity lines of credit, commercial loans, credit cards, things like that. Mortgage rates are actually based on a totally different model. They're based on mortgage-backed securities. And the reason why mortgage rates went up so much over the last 12 months is because of the fear of inflation. Now, the good news is that it feels like we are on the other side and that inflation is starting to come down. And that's why we're seeing mortgage rates improve, even though the Federal Reserve raised rates 1/4% last week. But the real shocker is the Fed funds rate is now close to 5%, which equity lines of credit, if someone goes into a bank and looks for equity lines of credit, they're sitting at close to 10%, between 9 and 10%.
Wow.
So again, mortgage rates are obviously much lower than that. So.
Mm-hmm. Right. Well, great information. Another great tip from Jerry Sant of Cross Country Mortgage. Thank you, Jerry. And I'm Sandy Bullowa with eXp Realty.